Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money world. This latest filing from Ensysce Biosciences Incorporated is a real doozy, a bit like trying to find a needle in a haystack of corporate jargon. But I promise we will uncover some interesting bits. Alright, so what is the big deal with this particular document? It's a proxy statement, a formal way for a company to ask its shareholders for permission to do certain things at their annual meeting. Think of it as shareholders getting to vote on important company decisions. Ensysce Biosciences Incorporated is holding their annual meeting and they need your vote on some key proposals. The meeting is slated for the 23rd of December 2025 and it's happening virtually, which means you can attend online from anywhere. This notice really lays out exactly what the company wants to discuss and get approval for. First up, they want to approve issuing more company stock and letting people exercise stock warrants. This is a really big deal for anyone who owns shares because it can affect how much of the company each share represents. They need this approval to follow rules from the Nasdaq stock market. Then there is approval to change their 2021 incentive plan. This is a plan that gives company stock and options to employees and others. They want to dramatically increase the number of shares available under this plan. This usually means they plan to give out more stock awards to attract and keep talented people. They also need to elect new directors. These are the people who will guide the company and make big decisions. You get to vote on who these leaders will be. Next, they want to rubber stamp their choice of auditor, the company that will check their financial statements, Baker Tilly Us Incorporated. Finally, they are asking for permission to postpone the meeting if needed to get more votes on the other proposals. This is a pretty standard request to ensure they can get everything done. Now let's dive a bit deeper into the actual proxy statement itself. Much of this document is about explaining why they are asking for these approvals and what the potential consequences are. This section is really helpful for understanding the logistics of the meeting, your voting rights, and how to cast your ballot. It clarifies that only shareholders of record on a specific date, the 29th of October 2025, get to vote. So if you're just thinking about buying stock, you need to do it before that date to have a say. It explains the different ways you can vote through the mail, online, or even virtually at the meeting. This is your chance to make your voice heard. Let's get into the meat of Proposal 1, the one about issuing more shares and warrants. On the 13th of November 2025, the company signed an agreement with an investor to sell them preferred stock and warrants. This is how they are raising money. The issue is that if all these new shares are issued or warrants exercised, it could represent a significant chunk of the company. The stock was sold at a specific price and there is a conversion price for the preferred stock into common stock. This is where dilution comes into play. If investors can convert their preferred stock into common stock at a price that is much lower than the market value of the common stock, shareholders who already own stock will own a smaller piece of the company. That means your percentage ownership goes down, meaning your part of the profits or future growth gets smaller. As of the 14th of November 2025, there were about 3.5 million shares out there. If this investor gets a lot more shares, it could increase that number significantly. This number is staggering. If the investor gets all the shares they're entitled to, it could represent 75% of the shares outstanding before they even do anything. This means the investor could wield considerable influence over the company. This is a huge dilution for existing shareholders. Essentially, your ownership stake gets watered down. If you owned 1% of the company now, you might own a much smaller fraction. If shareholders do not approve this proposal, the company faces a tricky situation. They may have to call a shareholder meeting every 45 days until they get approval. This is to comply with Nasdaq rules that prevent companies from issuing too many shares without shareholder consent. The board believes this is necessary to fund ongoing clinical trials for their TAP and MPAR programs and for general working capital. They say they explored other financing options, but this was the best they could get at the time. This hints at their financial situation where they need capital urgently. Now let's talk about Proposal 2. The increase to the stock incentive plan. This is all about giving employees and directors more stock options and awards. The company wants to go from 121,457 shares available to 721,457 shares. That's a more than 6 times increase. The reasoning is standard. It helps attract and retain talent by linking their success to the company's success. In a competitive biotech market, especially for startups, attracting experienced people is crucial. As of the 14th of November 2025, quite a few shares were already tied up in options, and only about 14,000 shares were left for new grants. That is not enough for a growing company. This increase would bring the total shares available for these awards to about 20% of outstanding shares. This is a substantial portion and highlights how heavily the company relies on equity compensation. This table provides a snapshot of their equity plans. It shows that as of the 31st of December 2024, there were 38,785 securities to be issued upon exercise of outstanding options and warrants and a weighted average exercise price of 501.65. Interesting then that it mentions only 10596 securities remaining available for future issuance under these plans. This suggests that not all the shares available under the plan can be used for grants. Next up is the election of directors. The board is made up of 8 directors. 2 are up for re-election and will serve for 3 years. One director, Mr. Andrew Benton, is retiring and they are not replacing him right away. This means the board is shrinking from 8 to 7 members. A smaller board can sometimes be more nimble, but it can also mean less diverse perspectives. We have William Chang, who has extensive business experience and was on Harvard University. Looks like a solid candidate for corporate governance. Then Lee Roch, an experienced CEO and strategy advisor with a background in biotech. Her experience building companies and securing financing is really valuable. Bob Gower is the chairman. His background is in petrochemicals, but he also founded Ensysce Biosciences Incorporated and has been involved with various public companies and non-profits. Curtis Roseborough brings a lot of experience from the regulatory side, having worked at the Food and Drug Administration for many years. His knowledge of drug development and approvals is a huge asset. Dr. Lynn Kirkpatrick, the CEO, has been with the company since 2009 and has a strong background in drug discovery and development. Her continued role as CEO and director is expected. Scrollodum S. Levin. Marilyn Swetosol, Dr. Adam Levin, is a highly credentialed individual from Johns Hopkins University with extensive knowledge in orthopedic surgery and oncology. His broad medical and management experience seems to be a key qualification. Steve R. Martin has a strong financial background, having served as CFO for several public companies in the biotech space. His accounting expertise is crucial. It seems the board is a good mix of experienced individuals with relevant backgrounds for a biotech company. Now on to Proposal 4, the ratification of their independent auditor. Basically, their old auditor Moss Adams LLP merged with Baker Tilly Incorporated. So they are just formalizing the appointment of Baker Tilly Incorporated as their auditor. The fees for their auditors are interesting. For fiscal year 2024, the audit fees were $409,678, and for 2023, they were $472,850, a slight decrease in audit fees year over year. There are also audit-related fees for compliance audits, which were $30,500 in 2024, down from $76,125 in 2023. The audit committee has reviewed these financials with both management and their auditors. This is standard procedure to ensure everything is in order. This section is always a crowd favorite. Here we see how much the top people at Ensysce Biosciences Incorporated are making. Let's look at the summary compensation table for 2024. Dr. Lynn Kirkpatrick, the CEO, earned a salary of $432,042 and a total compensation of $442,392, including other compensation. For 2023, her salary was $404,875 with a total of $508,575. This shows a slight decrease in total compensation in 2024 compared to 2023. Dave Humphrey, the CFO, earned $360,917 in salary in 2024 for a total of $371,267. In 2023, his salary was $338,250 with a total of $441,950. Again, a decrease in total compensation. Jeff Burkett, the Chief Commercial Officer, earned $333,625 in salary in 2024, totaling $343,634. In 2023, he earned $312,625 with a total of $392,354. His total compensation also decreased year over year. This table shows their outstanding stock options and awards. It paints a picture of how much equity compensation is tied up for these executives. For Dr. Lynn Kirkpatrick, there are still options from 2016 with a very high exercise price of $11,484.00. This is a lot higher than the current stock price, implying these options are likely out of the money and worthless unless the stock price skyrockets, which is unlikely. Similar situations appear for other executives with very old options and high strike prices. The pay versus performance table is where things get really interesting from a shareholder perspective. It tries to link how much the executives are paid to the company's financial performance. Looking at 2024, the summary compensation table total for the PAYO Principal Executive Officer was $442,392, but the compensation actually paid to the PAYO was also $442,392. This indicates that in 2024, a significant portion of compensation was actually paid out or vested, not just granted on paper, as is often the case. In 2023, for the payo, it was $508,575 in summary compensation, but the actually paid compensation was $507,187. Again, very close. Now look at 2022. The summary compensation was a hefty $622,609. However, the compensation actually paid was only $152,787. That's a massive difference. Almost $500,000 was granted, but not actually paid or vested. This difference of hundreds of thousands of dollars could mean a lot of equity awards were granted, but have not yet vested or their value decreased significantly. And what about the company's financial performance during these times? In 2024, they reported a net loss of $7,987,225. In 2023, a loss of $10,626,011. And in 2022, a much larger loss of $25,085,496. So while overall compensation might have slightly decreased in 2023 and 2024, the company is still reporting. The fact that in 2022, a large chunk of executive compensation was grant date value that did not translate to actual paid compensation speaks volumes about the company's performance that year. Directors also get paid. For example, Bob Gower received $25,000 and the others got between $7,500 and $15,000 annually. This is fairly standard for board service, but noteworthy given the company's financial results. Finally, Proposal 5 is about the adjournment of the meeting. This is a safety net to make sure they can get all the necessary approvals. Scrollso, what is my take on all of this? Ensysce Biosciences Incorporated is in a critical phase. They need capital urgently to fund their research and development programs as evidenced by Proposal 1 and the associated dilution for shareholders. This is a classic biotech startup move where they are balancing the need for funding against the impact on existing shareholders. The significant increase in the stock incentive plan also signals a strong reliance on equity to attract and retain talent, which is common but also means more potential dilution down the line. Management compensation has seen a slight decrease, which could be a response to the company's financial performance, though the gap between granted and actually paid compensation in 2022 is quite striking. The board composition appears strong with a mix of business regulatory and medical expertise, which is a plus. However, the company's consistent net losses raise concerns about their long-term financial sustainability. They need their pipeline drugs to succeed and generate revenue quickly. The key risk here is execution and clinical trial success. If their TAP and MPAR programs don't pan out, the dilution from Proposal 1 could be for very little future gain. The opportunity lies in the successful development of these novel pain therapies. If they hit the market and prove effective, Ensysce could see significant growth, and the current dilution could prove to be a worthwhile investment for the company's future. Overall, Ensysce Biosciences Incorporated is a high-risk, high-reward investment. They are making necessary moves to survive and grow, but shareholders need to be aware of the significant dilution and the reliance on clinical success to justify these actions. Alright, that is our breakdown of Ensysce Biosciences Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. We have a great community there discussing these kinds of filings. Thanks for watching. See you next time.